Good afternoon to everyone. Dear students, let us first discuss IFRS S1, S2, and then obviously we'll be discussing a past paper question as well. Basically, IFRS S1 and S2, they both are on sustainability, but S1 is more or less for the general requirement on sustainability. I would say that when it comes to the specific disclosures, what exactly investors they want to see in the disclosure relating to the sustainability, that purpose will be served by S2. Okay. As we have already discussed, even before discussing this article on S1 and S2, regarding sustainability, we have discussed a few things. In fact, we have seen two questions also. Basically, nowadays, investors, they are not only interested in your profitability, they actually want to see the sustainability of your organization as well. For example, what is the CO2 emission rate of your company? So majority of the investor, they really want to see that also. Because you are a profitable organization, for example, but the CO2 emission from your company is very high. And let's say it is higher than what government has given you the permission. It means your company is harming the environment, number one. Number two, when your emission is more than the what government has, let's say, given you the permission, it means that sooner or later you will have to face the penalties, number one. Number two, the bad image of your company is already spreading among the society, I would say, because you are harming the environment. So what happens then, even though you are a profitable organization right now, but in the future it would be difficult for you to maintain the profitability, because it doesn't, basically when it comes to the sustainability, something is really wrong with your company. So let me repeat. So it means that today's investors, when they are going to make investment in a company, they will just not make the decision on the basis of what profitability says, what your statement of financial position says. They really want to have the disclosure relating to the sustainability, that what sort of changes your company is bringing regarding sustainability and its impact in your current performance as well as in the future performance. So, and this area is so crucial, so important, that they had to make the standards. Just imagine that what investors they want to see in your financial statements regarding what your company is doing for the protection of environment. So the area is so important that ISB people, they have to come up with the standards, and they have made two standards, S1 and S2. Another thing is, if your company is again not following the requirement of the government and going for high emission of CO2, I would say, then obviously you will end up by paying penalties. You will end up by creating a bad impact in the obviously mind of your customers, investors, and obviously it will impact the overall reputation of your company. Now let's see IFRS sustainability disclosure standards. From September 2024, SBR exam will test candidates on the IFRS sustainability and disclosure standards. Candidate will need to be able to use their knowledge of IFRS S1 and IFRS S2 to assess disclosure of climate related risk and opportunities. If you're not looking after the climate, you will face the risk. Can I say, if you bring changes in your working pattern and you start looking after the climate, you bring changes in your working environment, and that basically improves the environment. So definitely it will build a really good image of your company. you will be able to attract more investors, and obviously it will increase the share price as well. So there are risks if you're not looking after the climate related issues, and there are opportunities as well. For example, please listen to the example. Obviously, we know that tobacco is not good for the health. Everybody knows that. But obviously, they are there. There are a number of companies that are involved in that. But what do they do? Number one, obviously, for tobacco, for making those cigarettes, they use basically wood. Now, obviously, it's not a overall activity is not good, but just an example. Recently, it happened. There's XYZ organization. What they did, they just brought a change in their technology regarding how they were manufacturing the cigarette and how they are doing it right now. So what happened? For example, if earlier they were using, I would say, just an example, 2 trees to make certain number of units of cigarettes, now they are using 1 tree. So basically, they're less consuming the wood. Obviously, when you consume less wood, it means less, I would say, CO2 also. So it will have a good impact on the environment. And it's not only having a good impact on the environment, obviously, you are getting the benefit also. If you develop the technology and due to that, you are producing the same thing, but not utilizing the same raw material. You're using less raw material to produce the same thing. So automatically there are opportunities also, and they will improve your profitability. Okay, candidate may also have to appraise the factors which impact the usefulness of sustainability related disclosures. This article highlights some of the key principles within S1, S2. Let's see, background. In recent years, there has been a growing awareness of sustainability related risks and potential impact which these may have on an entity's current and future financial position. So their impact on the current and the future financial position. Performance and cash flows. Investors require high quality information about these risks as well as potential sustainability related opportunities. What are the opportunities? When making investment decisions. Although sustainability reporting has become increasingly prominent, the proliferation of different voluntary reporting standards and framework has caused fragmentation. And this has limited the usefulness of the information provided. Basically, if every standard starts giving information about this sustainability, and if that information is scattered, so it will not be so useful. That is why they come up with a solution. Let's make standards. They will give us the disclosure of sustainability. The IFRS Foundation believed that information needs of investors were not being met. In response to this, they founded the International Sustainability Standard Board. Look at this. The matter is so severe, they have made a board. International Sustainability Standard Board, which has the aim of developing a global baseline of sustainability standards. Students, look at this. We already have the board for ISS and IFRS now. This sustainability issue is not a small. It is so, I would say, important, so severe that they made a complete different board. It means in the future, we should be mentally prepared to getting more and more, obviously, standards depth in these sustainability area. In 2023, ISB issued the first 2 sustainability risks. We are saying first 2. So be ready for many more are to be coming. And these are S1, IFRS S1 journal requirement for disclosure of sustainability related financial information. So S1, I think I just gave you the idea. Just give us the journal requirement. But when it comes to S2, it's not journal, it's climate related disclosures. These two standards are included in the list of examinable documents in SBR from September 2024 onwards. General requirement. Entities apply IFRS S1 when preparing and reporting sustainability related financial disclosures. S1 refers to 4 areas of core content that entities should provide in their sustainability related financial information. S1 refers to the 4 areas. Please, where I will highlight few points. You have to read it properly, and if I highlight few points, and I'll mention which area you need to memorize as well. So please, you do memorize that also. S1 refers to the 4 areas of core content that entities should provide in their sustainability. At least students try to memorize the definition of these 4 areas in S1. Governance. The governance processes used to monitor and manage the sustainability related risk and opportunities. Governance. In governance, basically, you have to tell us the process which your entity is using to monitor and manage what? Sustainability related risk and opportunities. Governance. Strategy. The approach of managing sustainability related risk and opportunity. This is strategy relates with the managing. Here we are just monitoring. Governance, monitor. Strategy, managing. Risk management, the process used to identify, assess, and monitor sustainability related risk and opportunities. In risk management, first you have to identify, assess, and then you will go for monitoring. The last one is extremely important. Obviously, if there are no targets in front of you, how will you evaluate the performance? Performance can only be evaluated when obviously we are going to compare the results against the targets. The entity's performance in relation to the sustainability related risk and opportunities, including progress towards any target set. So S1, 4 areas are extremely important in S1: governance, strategy, governance, the process, how you are monitoring and managing, just monitoring and managing governance. Strategy, managing sustainability related risk and opportunities. In risk management, we do have a monitoring, but before that, we have identify as well. For example, if I'm in a tobacco industry, so the climate related risk, they belong to me, they are different as compared to a company which is in the oil industry. We both are not having the same risk. We are having a different risk. So my management should identify, assess, and then monitor. Metrics and target is very important. Obviously, if we do not have any target in front of us, so how will we evaluate the performance? Are we performing good, bad? And if we are not performing good, so obviously we should be mentally prepared for the damages. It could be in the form of penalties. It could be in the form of bad reputation. It could be in the form of losing customers, investors. As well as applying the principles as IFRS S1, entities must refer to other issued IFRS sustainability disclosure standards when disclosing information about specific sustainability related risk. That is basically S2. This means entities must use S2 because when you will be providing a specific disclosure relating to the climate, you will be using S2. As no further IFRS sustainability disclosure standard have yet been issued, sustainability related disclosures related to the non-climate issues must be prepared using principles in IFRS S1 only. This is non-climate issues must be prepared using principles in IFRS S1 only. The ISSB will eventually draft, consult on issue and a suite of other sustainability disclosure standards. But the meantime, IFRS S1 requires user to consider the disclosure topics covered in the standards issued by the Sustainability Standard Board and to assess whether they are applicable. Obviously, each industry will have a different requirement, will not have the same issues. S1 does permit entities to omit information about sustainability related opportunities from sustainability related financial disclosures if that information is commercially sensitive. If you feel that that information is commercially sensitive, then you should not disclose that. However, the exemption does not apply to any information that is already publicly available. Obviously, if something is already publicly available, then you cannot hide it. Neither does it apply to a sustainability related risk, and it does not also apply to the sustainability related risk. So S1 does permit entities to omit information about sustainability related opportunities. For example, that my company has started taking actions, and due to those specific actions, the CO2 emission will be reduced by 50%. I don't want to disclose those actions. Obviously, that is an opportunity for us if I can achieve that, and I'm going to achieve it. So definitely we'll get the benefit. Why would I disclose what exactly steps we are taking and what sort of technology exactly we have developed and using it to get that benefit? So S1 does permit entities to omit information about sustainability related opportunities from sustainability related financial disclosure if that information is commercially sensitive. But if it is already public, then you cannot hide it. And plus, if there's any information which relates to sustainability related risk, you cannot omit that. Now, what is the interconnectedness? There are several similarities between the principle and concept of IFRS sustainability disclosure standard and IFRS accounting standards. Okay. Both sets of standards use the same two fundamental characteristics of useful information. Obviously, information has to be useful when it is relevant, faithful, and faithful representation, as well as the same four enhancing quality characteristics. It has to be comparability, verifiability, timelessness, and understandability. Obviously, if the information is not relevant, then what is the benefit? For example, if we are in the tobacco industry, so the information which is relevant for us might not be relevant for any other industry. So number one, information has to be relevant, and there has to be a faithful representation. And four enhancing qualities are comparability, verifiability, timelessness, and understandability as well. Obviously, if your information is not understandable, then again, there's no benefit. The definition of materiality across the two sets of standard is also same. We know that the information is material. If you omit or misstate, that changes the economic decision of the investors. Information is material if omitting, misstating, or obscuring that information could reasonably be expected to influence decision that the primary user of general purpose financial statement make on the basis of those reports. I think it's the same definition of the materiality everywhere. So as far as the concept of materiality is concerned, as far as the concept of relevant information is concerned, it is same in sustainability standards and other standards. Both sets of standards identify the same primary user of financial reports. Current and potential investor lenders, and this is very important. Okay, what is same? If there's a question of just 2 marks question, then what are the things which are same in other standards and in sustainability standards? So obviously the information relating to information, it is same. It has to be relevant, faithful, and information should be there, and there should be a comparability, verifiability, timelessness, understandability. Plus the definition of materiality is same in other standards and in sustainability as well. Plus both sets of standard identify the same primary user of financial reports. Obviously users will not change. Current and potential investor, lenders and other creditors. S1 specifies that sustainability related financial disclosure must be reported. At the same time, the related financial statements, the reporting period for the sustainability related information must also be the same as for the financial statement. Again, important point. If someone says that reporting period for sustainability and other standard is different, the answer is no, it is same. Both sets of standard require the disclosure of comparative information also. So students, please listen. If you find a question in exam, what are the similarities in sustainability standards and other standards? Number one is relating to the information. Second, materiality. Third, basic user of the financial statement, investors, lenders, creditors, they are same. Fourth, both will have the same accounting date. And both require the comparative information. The treatment of material, prior period errors in sustainability related financial information is also based on the same principle as IFRS accounting standard. These errors must be corrected retrospectively by restating comparative amounts for the prior period unless this is impracticable. If you look at this, it is exactly the same thing which your IS 8 says. Repeat. Let me repeat the question. If you find a question in exam that what are the similarities between, let's say, S1, or you can say the sustainability standards and other standards. So students, if this question gives you 5 marks, you should be getting 5 out of 5. So what are the similarities between other standards and sustainability standards? Number one is relating to the information. Second, definition of the materiality. Third, users of the financial statements are obviously same. Fourth, financial statement reporting end has to be same for both sustainability standards and other standards. Fifth, that accounting, or you can say the dealing with the correction of error, is exactly same in, you can even give the reference in IS 8 and sustainability standards. And other standards and sustainability both require comparative information as well. The treatment of material prior period errors in sustainability related financial information is also based on the same principle as in IFRS accounting standards. These errors must be corrected retrospectively by restating comparative amount for the prior period unless it is impracticable. Now, when we say climate related disclosures, so obviously now when it comes to the climate related disclosures, specific disclosures S2. Risk and opportunities, the SBR syllabus exams includes this. 2024 onwards requires candidate to assess disclosure, climate related risk and opportunities. Apply IFRS 2 when producing climate related disclosures. The purpose of these disclosures is to provide information about climate related risk and opportunities that primary user of its financial reports would find useful. Climate-related risk can be separated into two broad categories. Please, students, you should memorize this. Climate-related risk can be separated into two broad categories. One is physical risk. Obviously, if you're just doing the business, you have no idea about the climate-related risk, then obviously you will suffer the great consequences, like flood and other things. If you were not prepared for that, let's say you did not take the insurance policy. If you're not taking the insurance policy and if such an event happens, so obviously you have to bear a really big loss. So climate related risk can be separated into two broad categories: physical risk and transition risk. Actually, when the legal environment changes, and again, you are not aware of that, it could affect your business, I would say, significantly. Another example of transition risk is changes in the technology. If the technology is changing and you're not aware of that, it can again affect your business. Physical risk results from weather-related events, such as floods or droughts. They also result from a longer-term climate changes. For example, rising temperature may lead to a rising sea levels, as well as a loss of biodiversity. Okay. Transition risk result from the move towards a lower carbon economy. Look at this. Transition risk results from a move towards a lower carbon economy. Now you might be thinking, sir, if you are going towards lower carbon economy, so what is the risk? There is a risk. What is that risk? Let me tell you. Obviously, if the country is going towards lower carbon economy, so you have to contribute. If you're not contributing, so then law will affect you. If the law says you have to curtail the CO2 emission and you are unable to do that, so you will be in, your business will be in hot water. Then you have to face the consequences. Entities are required to provide disclosure about its governance, how you are monitoring, so that user of financial reports can understand how climate related risk and opportunities are identified, monitored, and managed. When identifying sustainability related risk and opportunities, entities must use all reasonable and supportable information that is available to them without undue cost of effort. Data resources can be internal, external, and might include risk management process. External reports, statistics, industry experience, assessment of what constitutes undue cost or effort will change over time, of course. Today, it is possible that cost is more than the benefit, but in the future, we never know. That cost becomes less and the benefits, there will be more. Benefit of the information provided to the users. The following is an example. This will give you a really good idea about opportunities and risk. The following is an example of a disclosure, some of the climate related risks and opportunities facing an international restaurant business. Physical risk. Our business model relies on large quantities of raw material. Okay. Increased levels of flooding due to climate change has affected the quantity and quality of several key ingredients. This leads to price volatility, which reduces profit margin. Look at this. There is a disclosure on physical risk. Our business model relies on large quantities of raw materials. Increased levels of flooding due to climate change has affected the quantity and quality of several key ingredients. This lead to price volatility, which reduces profit margin. So you can see one thing, why the profitability of this business has reduced: physical risk. Restaurants in some locations are heavily impacted by water shortages, chronic weather events. These events may cause temporary closure, but can also increase the cost of insurance premium. Transition risk. Climate related laws. Transition means laws. Climate related laws and regulations are regularly changing. Our restaurant operates in more than 90 countries around the world. Compliance costs are high. Moreover, increased regulation can result in a higher operational cost, such as in relation to the cost of energy. Many of our customers pay close attention to our climate related strategies and targets. If these are deemed insufficient, then our brand value will decline. Reputational damage will impact our market share and our share price. Now, opportunities. To achieve our goals, we are pursuing more efficient operations through investment in new technologies. In the long term, we expect a significant decline in the energy usage, with a resulting increase in the reportable profit margin. With regard to identify risk and opportunities, the entity would need to disclose the impact on its strategy and decision making. It must also outline the effect of the risk and opportunities on the financial positions, financial performance, and cash flows in the current period, as well as anticipated effect in the short, medium, and long term. So, very important point is with regard to identified risk and opportunities, entity would need to disclose the impact on its strategy and decision making. It must obviously, if now the chances of the flood, assuming, just an example, you are operating in a country where once in a year flood comes. If due to climate changes, now the estimations are that flood, instead of once, it is going to come, or let's say 2 times or 3 times. So there's a possibility you might be thinking to relocate from that country to another country. Because how you're going to save, or you might be then thinking for a better insurance policy. And obviously, when such events frequency will increase, there are greater chances that you will have to pay more insurance premium. More insurance premium will also affect your cash flow. So means you have to explain the risk which you have identified, the opportunities which you have identified, what is your strategy, how you're making the decision, how it will affect your financial position, how it will affect your cash flow position in the current period as well as in the future. To help user to assess adaptability of an entity, information must also be provided. For just an example, try to understand. Assuming your company is a Honda company. Okay, we know that Honda is a world famous company. Now, Honda people, they have realized that everyone is going on EV cars, electric vehicles. Now try to understand. If I'm the investor of a Honda, okay, and let's say if Honda resists, says that no, we don't want to go to EV cars. See, if you're not going for EV cars, and rest of your competitors, they are going on EV cars, so definitely number one, they will provide the benefit to the environment. Number two, trend is changing. People are more, I would say, environmental cautious now. They want to invest in those organizations. They are working in such a way that will give the benefit to the climate. So if Honda is not interested in EV cars, for example, obviously everyone is interested, even Honda is interested. So definitely then investor will be putting their money to a company, those they are more interested in EV cars. So adaptability. Let's say Honda will have to explain their adaptability that no, this is not the case. We have changed and we are working on that technology as well. And very soon, let's say, we will start manufacturing EV cars. Okay. Help users assess the adaptability of the entity. Information must also provided about the resilience of the entity's strategy and business. Model to climate related changes. This includes providing information about climate related scenarios analysis that entity has carried out. Metrics. Again, the same thing. Obviously, you have to have the targets in front of you, and then you will be evaluating your performance against the targets. Entities are required to disclose metrics and targets that will help the primary user understand its performance in relation to the climate-related risk and opportunities. IFRS S2 states that this involves providing information about any climate-related targets and the entity has set, as well as information about greenhouse emission, greenhouse gas emission. In accordance with S2, entities are required to disclose gross greenhouse gas emission. For example, you need to give us the information about your CO2 emission. And there are other gases like that also. This disclosure must be broken down into scope 1, scope 2, and scope 3. Let's see. Scope 1, direct greenhouse emission that occur from sources that are owned or controlled by an entity. Scope 1. Student, please try to, you need to memorize this scope 1, scope 2, and scope 3 as well. Just an example. You are the owner of a car. So obviously you are using the car. If you're using the car, so it means that is scope 1, direct greenhouse emission that occurs from the sources that are owned or controlled by an entity. Just an example, let's say if you are having a assembling plant and let's say that particular assembling plant is emitting CO2 emission. So that is scope 1. Scope 2, indirect greenhouse gas emission from the generation of purchase or acquired electricity, steam, heating, or cooling consumed by an entity. That is indirect greenhouse gas emission from generation of purchase or acquired electricity, steam, heating, or cooling consumed by an entity. So these are indirect gas emission. And the last one is indirect gas greenhouse emission not included in scope 2 that occur in the value chain of an entity. Just an example, for example, let's say I want to we buy a raw material. Now try to understand, obviously when I am buying a raw material, so supplier has to supply that particular raw material to my premises. So supplier providing that raw material, let's say delivery to my premises, again, that due to that, what is happening? In that supply chain, what is happening? Basically, there is a CO2 emission and because of my work. So indirect greenhouse emission not included in scope 2 that occur in value chain of an entity. Obviously, when I'm converting a raw material to the finished goods, so I'm creating a value in my product, but during that also the greenhouse emission is there. Now look at the example. An example disclosure of gross greenhouse emission is provided below. Greenhouse emission, metric ton CO2 emission, X6, X5. Scope 1, the resources which you directly own. In X6, this is the target. Previously, this was the target. S2, the target is reduced as compared to the previous year. And S3. Now, obviously, if the scope S1, S2, S3 target is here, you will compare your actual performance against these targets. This disclosure is important because it helps user of the sustainability related financial information assess entities exposure to climate related risk and opportunities. Entities with higher greenhouse emission are potentially more exposed to climate related transition risk. Obviously, law will affect you more because they will be more heavily impacted by the legal, technological, market, and reputational risk, in particularly shifting consumer demands. could lead to severe reputational damages for entities that do not make sufficient progress in reducing their. If you're not helping to reduce your greenhouse gas emissions, so you will end up by losing customers, you will end up by creating a bad reputation, you will end up by in leaving investors, they will leave you. For some industries, scope 3 emissions can account for almost 90% of the total greenhouse emission. For this reason, scope 3 emissions are sometimes perceived as a hidden risk, especially if undisclosed. The requirement in S2 to disclose a scope 3 emission therefore gives a more complete picture of an entity's overall carbon impact. It also enables investors to compare the carbon impact of an entities with different business models, such as those which heavily outsource the activities and those do not. It can be difficult to measure greenhouse gas emission, particularly those falling in scope 3, and many different methodologies exist. For this reason, S2 requires entities to measure greenhouse gas emission in accordance with Greenhouse Gas Protocol, a corporate accounting reporting 2004, unless an entity is legally required to use different method. This consistent approach reduces the risk of bias, helping ensure a faithful representation of underlying phenomena. There are also some exemptions simplification for entities in S2. First year of applying S2 targets. S2 requires entities to provide information about the climate-related targets it has set. Below is an example of an extract from a disclosure note for an international business hotel. The company aims to reduce water consumption per occupied room by 20%. International hotel business examples. The company aims to reduce water consumption per occupied room by 20% from X0 baseline until X9. By the end of X6, the reduction in water consumption per occupied room is 8.4%. We are behind schedule on this goal, but continue to explore opportunities to reduce water consumption. Look at this. How this hotel business is actually looking after the climate. I still remember, just let me give you an example. It's a the way back it happened. I still remember, I think it was 2012 or 13, somewhere like that. I was in the Maldives on a very good island. So it was full board. Obviously, there was a really big restaurant also. And in Maldives, there are islands, and each island will have obviously the hotel and restaurant, each and everything is there. So I still remember that I was eating, I think, dinner, and I wanted to just throw a little bit food for the fishes. So as soon as I was about to do that, one waiter, he came to me, he said, "Sir, please don't do that, because if you start feeding the fishes, it will kill their hunting ability." So I was very surprised. That's great. Second, then I also asked them that you people are running a really big restaurant as well. So what about that CO2 emission? Where it goes, I can't see anywhere. Then they explain me a very, I would say, one of the good ways or best ways of dealing with that CO2 emission. It was a properly folded and somewhere very, very far, or maybe somewhere too down to that sea or ocean, whatever you say. So I would say they used the technology, and it was in a very, I would say, in a smart way, they were dealing with that. That you could not see any CO2 emission. There wasn't anything like that. So it means, obviously, the people there in the hotel industry, they are also looking after the environment. The company plans to reduce net carbon dioxide emission by 30% from X0 baseline by X9. To achieve this, we will reduce gross emission by 10%, while also making use of carbon credits. These credits are generated from projects that use technology to capture carbon dioxide from the atmosphere before storing it safely underground. Wow. The carbon credits have been independently verified by the Global Carbon Council. By the end of X6, net and gross carbon dioxide emission had reduced by 24% and 2% respectively. We are behind the schedule on the gross target, but have implemented a new executive management share-based payment scheme, which will vest if the goal is achieved. Wow. If entities disclose a set of greenhouse emissions target, S2 also requires disclosure of the gross target. This is because the reduction in the net greenhouse emission can be achieved without making changes to the entity's business model. For instance, through the purchase of carbon credits, S2 defines carbon credit as an emission until it is issued by a carbon crediting program and represents an emission reduction removed from the greenhouse. S2 requires entities to disclose the planned use of carbon credits to achieve net greenhouse gas emission target. Disclosure of planned use of carbon credit is achieving climate related goal is important because some carbon capture technologies may prove ineffective, obviously, but some are going to be effective. There might be a change in the regulation that ban entities from using certain schemes. The prices of carbon credits may also change significantly, which will impact these plans and therefore the entity's ability to meet the targets. So students, I strongly believe that now every one of you should be having a really, really good idea relating to S1, S2 on sustainability. I'm expecting, I'm not sure, but I have the expectation that around 8 to 10 marks questions should be there on sustainability on S1, S2. I would say at least just go 3 to 4 times on this article. Just read this article 2 to 3 more times properly, and that would be good enough. If the question comes on sustainability, so you will be in a position automatically to give the answer. Let me just save this page, and we are taking a 5 minutes break before we go to the question discussion. So after 5 minutes, we will start. Have you attended the previous classes? Not the last class. I think we have discussed 2 past paper question on sustainability. Yes or no, please reply. We have discussed 2 questions on sustainability. Have you attended all the classes? So those 2, I think before the discussion of S1, S2, we have discussed the 2 questions on sustainability, and I said just watch the last 3 lectures. Leave the recent last one, and before that 2 lectures. In both the question, there was in both question, I think there was 5 marks question on sustainability. So please check those questions. And while we were discussing this article, I did highlight few ideas which I want you guys to try to memorize. For example, like this, scope 1, scope 2, scope 3. You should know that. Also look at this, how they are providing the disclosures and the definition of physical risk. It should be on your fingertips. Transitions risk definition. You should be able to explain. Even if 3 to 4 marks question comes and which says explain physical risk and transition risk in S2. So you should be in a position to explain what do you mean by transition risk. And let's say you should be able to discuss something on opportunities as well. And few journal things. If an entity is not following, let's say, is not looking after the climate changes, and is the way they are practicing it is harming the environment. So obviously, you will lose customer, your reputation will be damaged, and you will lose the investors. And you will end up by penalties as well, paying the penalties. It's not only you will be just paying the, you will be just losing the customers, you will end up by paying the penalties as well. So students, exactly, I would say after 10 minutes, we will start the, resume the class. So either you stay online, it's better to stay online. And before resuming the class, I'll drop the message in your WhatsApp groups as well. Okay, students, let's discuss another homework question. Jacinta, I believe, came in September, December 23. Let's read the requirement. It's a 25 marks question. Explain how Jacinta company should account for the credit impaired loans in the financial statements for the year ended 31st December X6. Credit impaired loan means obviously we are talking about IFRS 9 and impairment accounting. Your answers should include journal entries. Okay. So you have to also prepare the journal entries. 8 marks. Then B1, explain how the revenue from internet service, contract and sale of equipment to share company should be accounted for in accordance with IFRS 15 revenue from contracts with customer 10 marks. IFRS 15. Then we have a 7 marks question. Explain with calculation how the sale of inventories would be accounted for in the individual financial statement of both Jacinta Company and overseas subsidiary at 1st September X6 and in consolidated statement of Jacinta Group on December X6. So individual company of parent and subsidiary, how you will account for. In group accounts, how will you account for? So I think looks easy question. Let's read the scenario. Jacinta Company is the parent company of a group. Okay. So Jacinta is the parent company. Its main business is the telecommunication sector. The main business is the telecommunication sector. With the continued expansion of products and services. It has also developed a credit risk management business. Great. The financial year December X6, the functional and presentation currency of Jacinta and Jacinta Group is the dollar. So we know that any currency which other than functional is a foreign currency. So they have basically mentioned the functional currency which is dollar. The following exhibit provide information relevant to the question. Loan portfolio describes the purchase of credit impaired loans by Jacinta Company. Then we have revenue and inventories. Let's deal with this loan portfolio. Jacinta Company purchases credit impaired loans, measures these at amortized cost, IFRS 9. Jacinta Company correctly calculated the loss allowance as the changes in lifetime expected credit losses since initial recognition of asset, which is effectively the changes in the estimate of cash flows. Jacinta Company purchases credit impaired loans, measures these at amortized cost. Fine. Jacinta correctly calculates the loss allowance as the changes in lifetime expected credit losses since initial recognition and of the asset, which is effectively changes in the estimated cash flows. Let's see. On January X6, Jacinta Company bought credit impaired loans with a remaining term of 4 years. Jacinta Company paid 32 million, which is equivalent to the fair value. So you can say their investment is 32 million. On January X6, the remaining contractual cash flows are expected to be received on December each year. So this is what they are expecting to receive. The credit adjusted effective interest rate is 3.9%. During the year ended December X6, 8.8 million was collected, and December X6, the credit worthiness of the loans has improved. Great. Jacinta Company now expects the following cash flows to be collected. Now, instead of getting 8.8 million in every year, in the remaining 3 years, now they are expecting to get what? 10 million on each year. Now, please, first of all, obviously, you have to discuss IFRS 9. Obviously, here the scenario deals with the scenarios of IFRS 9. There's no doubt about it. Number one, and under IFRS 9, the area is impairment losses. If you just recall, under IFRS 9, when we say impairment losses, so actually IFRS 9 works on expected credit losses. Under IFRS 9, when we apply impairment accounting, so actually before the event occurs, impairment accounting starts far more earlier than that. And under IFRS 9 actually work on expected credit losses. Okay. Another thing is, when you have initially purchased the credit impaired, I would say investment or loan asset for 32 million. So logically, you can say that logically, that this when you have initially purchased this loan asset or investment of 32 million, so definitely you know that what exactly you have purchased. You have purchased the credit impaired loans. So initially, you will keep this at 32 million at the purchase price. Now what? When it comes to what they were expecting to get 8.8 million every year. And in 2006, they have actually received 8.8 million also. It means that if I just show you a little bit accounting, they bought this third investment on 1st January X6. This is your financial asset, 32 million. Cash, 32. Okay. Your effective interest is 3.9%. Examiner has not given us any cash interest, okay? It means brought down. Can I say finance income will be according to the effective interest rate, which is 3.9%? Simply take the receipts and carry it down. December X6, the brought down is 32 million. If I take 3.9% of 32 million, I'm getting 1.25. And we have received 8.8. It means the carried down value will be 32 plus 1.25 minus 8.8. I'm getting 24 point. Now double entries. If you ask for the double entries, financial asset will be debited by 1.25 and obviously finance income. Profit and loss will be credited by 1.25. Receiving 8.8 million means cash will be debited by 8.8. Financial asset or investment, whatever word you want to use, will be credited. Okay, these are the few, I would say, double entries which you have to make. Now, initially we were expecting to get 8.8 million every year, which means that remember right now we are at December X6. What we were expecting earlier. We were expecting earlier that we'll be getting 8.8 million every year. Let's discount this at 3.9%. The discount factor the first year is 0.962, then 926, then 0.892. Present values. 8.8 multiplied by 0.962 gives me 8.47. 8.8 multiplied by 0.926 gives me 8.15. And this. So I'm getting 24.47. Now, please listen carefully. Previously, this is what they were expecting. But obviously, now the conditions, they have changed. If the conditions, they change, and in fact, the change is the improvement. And due to improvement, basically, your loss allowance will decrease. And decrease in the loss allowance means if the loss allowance will decrease, simply you have to debit the loss allowance and credit the profit and loss. Now we are not expecting to get 8.8, we are expecting to get 10 million every year. 10, 10, 10. Cash flows, discount factor will remain same, which is 3.9%. Zero 0.926 and 0.9.62, 9.26, 8.92. So 9.62 plus 9.26 plus 8.92 gives me 27.880. So there is a favorable change in the lifetime expected credit loss. The change is now we are expecting to get more amount, which means that 27.80 minus logically with this 3.34, your loss allowance should be debited and P&L will be credited. And loss allowance will not affect the carrying amount of your financial asset. Repeat. Loss allowance will not affect the carrying amount of your investment. Improvement in the loss allowance, the double entry is loss allowance is debit, P&L will be credited. Just give me a minute. I hope we have the answer of this question. What they have done. Just a minute. It's here. This is the one. Yes, yes, yes. Okay. Student, look at this quickly. IFRS 9 financial instrument requires recognition of impairment losses on a forward-looking basis, which means that impairment losses are recognized before the occurrence of any credit event. Because the name of impairment loss model is expected credit loss. These impairment losses are referred to as expected credit losses. IFRS 9 requires that a loan be reported with its risk of expected loss, regardless whether the risk has already materialized or will materialize in the future. The purchase credit impaired financial assets are recorded on initial recognition at a transaction price without presentation of an allowance for expected contractual cash shortfalls. This is because the expected shortfall are implicit to the purchase price, because it will be obviously you will buy such a thing at a cheaper price. So this is the initial recognition. Examiner has used the word loan asset. If you have used the word even investment, financial asset is all acceptable. December X6, okay, it was same. No issue at all. The amount recognized as a loss allowance for these assets is not the total amount of lifetime expected credit losses, but instead changes in the lifetime expected credit loss since initial recognition of the asset. Obviously, now the changes are coming. Any favorable change in the lifetime expected credit loss is treated as an impairment gain. So let's see what is the accounting for the impairment. Previously, okay. Now, the resulting favorable change in the lifetime is therefore 3.34. An impairment gain 3.34 million is recognized in the profit and loss. Loss allowance is debited and P&L will be credited. At December X6, the following amounts. Okay, I'll do that. No issue. December X6, the following amounts will be recognized in the statement of financial position. The carrying amount will be this, and loss allowance will be debited. Okay. Actually, the discount factor is 3.9%. So 1.039 minus 1. Can you use the calculator? Students, are you getting these results? Yes or no? Is it okay now? How to get these discount factors? No issue, no issue. So let's go back to the question. Now IFRS 15. Revenue from share company. Okay. On January X6, Jacinta Company entered into a contract to provide share company with an internet services for how many years? 2 years. Stop. When it comes to IFRS 15, so most of the time we need to actually discuss and we need to know and we need to decide either we should recognize the revenue over time or point in time. Either we should recognize the revenue over time or point in time. Can I say if we are required to provide services over 2 years, then we should be recognizing a revenue over 2 years. And this time revenue will be recognized over time because as you will be providing the services, your customer will be getting the benefits. January X6, Jacinta Company entered into a contract to provide share company with an internet services for 2 years. The contract price was agreed 2 million, which was received in full, even though you have received 2 million initially, but it should be recognized 1 million in each year. January X6, at the same date, Jacinta Company sold equipment to share company at its fair value 5 lakh. You have sold the equipment to a share company. Can I say you will recognize the revenue when the performance obligation is satisfied, and the performance obligation will be satisfied when simply you have given the control of your asset to the customer. At the end of the internet service contract, December X6, 7. Share company has the right to return the equipment to Jacinta Company and receives $20,000. Now, please, student, try to understand the arrangement. Jacinta Company selling. See, as far as internet services is concerned, we have already discussed it will be recognized over 2 years. Every year, 1 million finished. Then the second issue is Jacinta Company has sold an equipment to Share Company for 5 lakh. Fine. But there's share company has a right to return that asset to Jacinta company and get how much? $20,000. Okay. Buyer has the right to return the asset and to get $20,000. Now try to understand. Jacinta company anticipate the equipment fair value will be 75,000 in 2 years' time. Now stop. Buyer has the right to return the asset to you and get 20,000. Student, just tell me one thing. If we are the seer company and we have two options. One, we can return that asset to the Jacinta company and get $20,000. And the second option is, or to sell in the market to get $75,000. So where will we go? Are we going, will we go for $20,000 or 75? Please reply. What buyer is going to do? Buyer will be happy to get $20,000 or will go for 75. Students, please, can you comment on that? Obviously 75. Obviously 75. But why would I go for 20,000? So it is quite clear. The share company is not going to return this asset. Let's read more. The market for second-hand equipment is very strong, and share company would be able to sell equipment easily at the end of the 2 years agreement. Jacinta company does not want to deal in the second-hand equipment and therefore always prices equipment returns at an amount substantially below fair value. Look at the strategy of Jacinta. Jacinta does not want to deal with the second-hand equipment, always keeps a very low price, and Jacinta knows that buyer will not exercise that option and buyer will sell that asset into the market. Share company has never returned the equipment to Jacinta in the past. Now listen carefully. There are two arrangements. One is internet services and the second is equipment. When it comes to internet services, revenue should be recognized over time and over 2 years, 1 million in each year. That's it, finished. When it comes to the equipment, okay, obviously when performance obligation relating to the equipment is satisfied, fulfilled, you will recognize the revenue. Now listen to me carefully. Now the question is, Jacinta company should recognize the revenue at 5 lakh or 5 lakh minus 20,000 at 480. Now listen carefully. Logically, it is quite clear from the scenario. The share company is not going to return this asset to the Jacinta. And second hand market value of the asset is quite established, and it is quite obvious the market value is far more higher than the 20,000 pound. So simply share company is not going to return that asset to the Jacinta. So simply the revenue should be recognized at 5 lakh. It should not be recognized at 480. Is this clear to everyone? So revenue relating to internet services 1 million each year. Equipment 5 lakh. Let's see what they are saying. In accordance with IFRS 15, revenue from contracts with customers, each performance obligation requires the determination of whether it is satisfied by transferring the control of goods or services over time or at a point in time. With regards to the internet services contract, the customer simultaneously receives and consumes the economic benefits of the provided services as Jacinta company performs it. Revenue is therefore recognized over time. Revenue $1 million will be recognized in each year of the contract, and the summer X6 1 million will be recognized, fine. And 1 million will be presented as a contract current liability on the statement of financial position because you have received in advance. You have received initially 2 million in advance, 1 million is recognized as a revenue on December X6, remaining 1 million is your liability. Now equipment. IFRS 15 states that if a customer has a right to require the entity to repurchase the asset at a price which is lower than the original selling price, then entity must assess whether the customer has a significant economic incentive to exercise the right. A key factor to consider is the relationship between the repurchase price and the expected fair value of the asset at the date of repurchase. If the customer has significant economic incentive to require the entity to repurchase the asset, then entity accounts for the agreement as a lease. Unless the contract is a part of sale and leaseback transaction. If the customer does not have the significant economic incentive, then entity account for the agreement as a sale with a right of return. Okay. Sierra company does not have a significant economic incentive to require Jacinta company to repurchase the asset because repurchase price is only $20,000. It is lower than the expected fair value of 75. Additionally, the market for the second-hand equipment is very strong, and Sierra company would be able to sell equipment easily at the end of 2 years agreement. Therefore, Jacinta company has transferred the control of equipment to Sierra company on January 6. This is because Sierra company is not limited in its ability to direct the use of the equipment or its ability to obtain substantially all the remaining benefit from the equipment. Jacinta will account for the transaction sale as a sale with a right of return. Okay, now look at this. Revenue with the measure at gross transaction price 5 lakh less expected level of returns, which in this case will be nil. This means no refund liability or return asset will be recognized. Jacinta company will update the measurement of the refund liability, return asset at each reporting date for changes if changes in expectation about the amount of refunds. Okay. See, for example, let's say after 1 year, if it looks that market value will be just $5,000, then obviously we have to reverse the, then we will, Jacinta will need to recognize a liability of $20,000. Did you get this point? Because after 1 year, if you come to know that the market value is just $5,000, so obviously customer is going to exercise its right of return. Then we need to recognize, obviously revenue will be debited. You will reduce the revenue. Right now, we will not account for. Right now, we are not doing anything. Right now, so obviously what examiner is saying, we will be with that. But what will happen in the future, we don't know. Is it clear? Yeah, as an estimate, obviously. If the probability changes in the future, then obviously impact will be number one, prospective. And Jacinta company will need to recognize the liability. Okay. If in the same year, for example, let's say in the year of sale, assuming after 6 months, the change has come within 6 months. I'm just assuming, okay? Let's say day one, I have recognized the cash debit by, for example, 5 lakh, revenue credit by 5 lakh. After 6 months, or maybe at the end of the year, in the year of sale, probability changes. And my team says now, sir, the market value of the second-hand value asset has become very less. It is just $2,000 rather than 20. And now they are saying, sir, customer is going to utilize his option to return that asset. If this is the case in the year of sale, I'll say, okay, instead of recognizing a revenue 5 lakh, go for 480. And by 20,000, increase your liability. So revenue will be debited by 20 and the liability will be credited by 20. But assuming, I'm just assuming, it is not happening. No, please listen. Assuming year of sale is passed, okay, and everything was fine. We have recognized the revenue 5 lakh, everything. Now, second year has started, and let's say mid of the second year, or assuming the end of the second year, we have just came to know that second-hand value is very less, and it is quite obvious that customer is going to ask us to pay $20,000. So it's okay. then that 20,000 you can just now in next year, if it is happening, just debit the P&L and credit your financial liability. So in the year of sale, it is happening, revenue will be debited and liability will be credited. If it is happening in the next year, then profit and loss will be debited and liability will be credited. Is that clear? If probability changes in the year of sale, what happens? If the probability changes in the next year, then what will happen? Please student comment on that so that we can go ahead. Yeah, it's a change in estimate. Change in estimates. We cannot bring the retrospective impact. It has to be prospective impact. Okay. Let's come here. B2, we have to basically show the impact of sale of inventory in 3 books. Individual books of seller, buyer, and group accounts. How many marks? 7. Sale of inventories to overseas subsidiaries. On 1st September X6, Jinta company sold inventories costing 1.35 million to a wholly owned overseas subsidiary for 2 million. There is no right of return. There is no right of return. Jinta. Now I'm just explaining. Jinta individual books. Obviously, Jinta individual books, they will recognize the revenue of 2 million. Logically, they will also recognize the profit of how much? Their profitability will increase 2 minus 1.35. In the individual books of Jinta, obviously the revenue will be 2 million and the profitability will increase by 0.65 million. Is this clear? Individual books of Jinta, yes or no? You will recognize the revenue of 2 million and the profitability will increase. This is Jinta's individual books. Okay, individual. Now, what is a subsidiary? Is a wholly owned subsidiary and okay. Overseas subsidiary. The subsidiary has a euro as its functional currency. The exchange rate on the date of sale from Jinta company to overseas subsidiary was $1 is equal to euro 1.25. It means 2 multiplied by 1.25 euro 2.5 million. So obviously for the subsidiary, purchases is 2.5 million. Is this clear? For the subsidiary, purchase price is 2.5 million. Is this clear? Yes or no? Please don't reply. Okay. Purchase price is 2.5 million. Now what? December X6, subsidiary still holds the goods in the inventories. Okay. This euro 2.5 million will be in the stock. Year-end exchange rate is $1 is equal to 1.3. There is no intercompany debt outstanding at the year-end. Very important point is there's no payable, there's no receivable. Okay, wait. There's no payable, there's no receivable. They have settled that. Now group accounts. Can I say in group accounts? 2 minus 1.35. It is how much? 2 minus 1.35. 0.65 million. Can I say number 1? In group accounts, intra-group profit of 0.65 million will be eliminated. Repeat. In group account, 0.65 0.65 million will be eliminated. Is this clear to everyone? Yes or no? Okay. Now please try to understand one point. Actually, the stock was sold for 2 million. Out of that 2 million, 1.35 million is the cost of the stock and 0.65 million is the unrealized profit. In day one, exchange rate was 1.25. I just want to show you one thing. 1.35 into 1.25, I'm getting 1.6875. 0.65 multiplied by 1.25, I'm getting 0.8125. Okay. We know that in individual books of subsidiary, the purchase price is euro 2.5 million. Fine. In the group accounts, we have already decided that unrealized profit of 0.65 million will be eliminated. Done. Now listen carefully. It means still when it comes to the subsidiary, logically subsidiary is having this stock because the stock is unsold. So we will not be working on the 2.5 million. We will be working on just 1.35 million. Why we are not working on 2.5 million? Because logically, initially we sold this stock for 2 million. Out of that 2 million, 0.65 million in dollars. In euro, you can say 0.8125 million. This impact we have already eliminated in the group accounts. It means that the stock value to which we have to retranslate, it is not euro 2.5 million, it is euro 1.6875 million. Are you getting this point? Repeat. The value which we have to translate, it is actually not the entire 2.5 million euro. It is euro 1.6875 million. Now, exchange rate is $1 is equal to 1.3 euro. I have to convert that into dollars so that we can consolidate. If I divide 1.6875 by 1.3, let's see what are we getting. 1.6875 divided by 1.3. I'm getting $1.298. So logically, initially this stock was having a value of $1.35 million. Now it is having a value of $2.98 million. Logically, there is an exchange loss. Now listen carefully, please. Can I say the non-monetary assets are not retranslated in individual books? Right now we are discussing group accounts. Can I say when we studied the group accounts, I did mention that entire net asset of the subsidiary will be retranslated by using the closing rate. When we say entire net asset of the subsidiary will be retranslated by using the closing rate, so this accounting is very different from the individual books. So I'm converting euro into dollars so that I can do the consolidation. Is this clear now? Obviously, you have to retranslate all the net asset of your subsidiary on each reporting date. That's what we are doing. Because there's no question of translating the individual books. So 1.35 minus 1.298, 0.052. There's an exchange loss. And this exchange loss will go to obviously exchange reserves. Now let me explain. Number one, parents will recognize, individual books of Jacinta will recognize a revenue of 2 million. Their profitability will increase by 0.65 million. Buyer will recognize a stock at 2.5 million. In group accounts, we will eliminate intra-group profit, 0.65 million. And then we will just retranslate this, the stock of 1.35. When I convert that into euro, it comes 1.6875. But at the year end, when we'll be converting 1.6875 again into the dollars, logically there is an exchange loss. Let's see what examiner is saying regarding this. Number one, Jacinta Company, 1st September X6, when recording the sale of 2 million as revenue in September X6, the cost of the inventories is 1.35. Jacinta realized the profit, no issue at all. Subsidy. The subsidy has recorded a cost of fine. At 1st September X6, the cost of the inventories includes the original cost, this, and plus an intra-group profit. It is okay. They have just given us the breakup of 2.5 million. Now group accounts. On consolidation, December X6, the intra-group revenue and cost of the sale should be eliminated. We know the intra-group sale will be eliminated, intra-group purchases will be eliminated, and unrealized profit will be eliminated. Is also eliminated. As the inventories have not been sold and the profit is not realized. Fine. When the subsidiaries financial statement are translated into presentation currency of the group, the cost of the inventory 1.6875 million is translated at the current exchange rate, and now it is this dollar this. Initially it was as a part of translation reserve associated with this, so there will be a loss of 0.51923 million, or you can say this 0.051, which we have calculated. Because the subsidies are wholly owned subsidy, there is no non-controlling interest. Out of this 7 marks, a student should have taken, I would say, at least 5 marks. At least you should be able to properly write the treatment in individual books of parent, individual books of subsidy. There's a chance of making a one error in the group accounts, but still out getting 5 out of 7, they're really good marks. So student, we have discussed one more question of the December 23. Still, if you ask regarding homework, 2 questions are left. Definitely we'll be discussing, not today. In the next class, and the timing of the next class we will share on Monday. But I would please every one of you, number one, try to complete the lectures. And number 2, please do not ignore all the homeworks which we have shared. We still 2 questions are left. Yes, basically in group accounts, when we retranslate the subsidy, then there is no differentiation between monetary and non-monetary items. The monetary and non-monetary items, they are only for the individual books. Yeah, yes. Entire P&L is translated by using average rate. Entire P&L is translated, subsidies P&L is translated by using average rate. So student, please do give the feedback of today's class in your WhatsApp group and try to attempt the remaining homework question, which we will be discussing also. And please get ready for the mock also. On Monday, we are going to share the timings of the mock, each and everything. And I'll ask the admin to share more homework as well. I'm expecting at least 6 more questions of the recent attempt. So 2 are still there, but 4 more, or maybe let's say 6 more. Then slowly and gradually we'll be discussing each and every question. So thank you very much, student, coming up for the live class. Have a nice life.